The ultimate day trading plan you need in 2026. Many retail traders struggle to find a single, clear, profitable trade setup. But why does this happen? It's not because they lack dedication or haven't studied the markets. It's because they try to apply too many conflicting trading concepts on their charts at the exact same time. They load their screens with trend lines, Fibonacci levels, RSI, MACD, support, and resistance until the chart looks like a chaotic web of lines. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you. This overload of visual data creates analysis paralysis. When your trend line says buy, but your RSI says overbought, and your support level looks weak, you end up doing nothing, or worse, making an emotional decision. In this masterclass, we're going to simplify all of these concepts and show you a highly effective day trading strategy. This system combines the most important principles of smart money concepts into one clear, mechanical trading plan. If you want to stop the confusion and start trading with institution-level clarity, make sure to hit the like button and watch this video until the very end. Part 1. Supply and Demand and the 3 Golden Filters. Let's start with the foundation, supply and demand. From an institutional perspective, supply and demand zones are areas on the chart where large banks and algorithms placed significant orders in the past, causing the price to expand away aggressively. When price returns to these zones, we expect a reaction because of the leftover order flow. However, you cannot trade every single zone you see. You must filter for the strongest ones. To do this, we look for 3 vital factors. The first factor is inefficiency, often called a fair value gap, FVG. Inefficiency occurs when there is a massive imbalance between buyers and sellers, resulting in a rapid vertical price expansion. This imbalance leaves behind a gap between the wick of the first candle and the wick of the third candle in a 3-candle sequence. This gap represents a price range where only one side of the market was delivered, leaving unfilled institutional orders. This gap acts like a magnet, drawing the price back to fill the empty space in the future. The second factor is the break of structure, BOS. For a demand zone to be considered high quality, the aggressive push originating from it must successfully break through the previous market structure level to the upside. In a bearish scenario, the supply zone must cause a break of the previous swing low to the downside. This BOS proves that buyers or sellers are in complete control of the momentum and have pushed the market into a new expansion phase, validating the strength of the originating zone. The third factor is push distance. This refers to how far the price moves away from the zone before it eventually starts to pull back. The further the price travels, the more significant the rejection is, and the more reliable the originating zone becomes. When a zone pushes the price incredibly far, it tells us that institutional players are heavily committed to that level. By stacking inefficiency, break of structure, and push distance, you can identify highly reliable institutional zones while completely ignoring weak, low probability levels. Part 2. Understanding the change of character, CHoCH. What happens when the price actually returns to our high-quality demand zone? We expect a reaction, but what if the price does not respect the zone? What if it breaks and closes below the demand area? This brings us to our next core concept, the change of character, commonly known as a CHoCH. In an uptrend, if price breaks and closes below the last swing low that led to the highest high, it signals a CHoCH. This indicates that buyers have failed to hold the level and sellers have taken absolute control, marking a potential trend reversal. However, many retail traders get trapped here because they don't realize that a CHoCH can often be invalid. There are 2 common scenarios of a false CHoCH that you must understand to protect your capital. The first scenario is a liquidity hunt. Smart money knows that retail traders place their stop losses just below the swing lows. Therefore, algorithms will intentionally push the price below the swing low to collect that liquidity, and then immediately reverse and continue the original uptrend. If the price breaks the low but quickly snaps back and closes inside the range, it is not a CHoCH. It is simply a stop hunt. Part 3. The mitigation of fair value gaps and order blocks. The second scenario of an invalid CHoCH is fair value gap mitigation. Sometimes a major swing low sits directly above an unfilled FVG. The price will break below that swing low simply to fill the gap and mitigate the institutional imbalance. Once the gap is filled, the price will resume its upward journey. Retail traders see the break of the low and sell, only to watch the price shoot up. This is why you must always check the left side of your chart for unmitigated gaps before declaring a structural shift. This leads us directly to order blocks. OB. An order block is a refined supply or demand zone. Specifically, a bullish order block is the last down close candle before a strong upward push that breaks structure and leaves behind a fair value gap. A bearish order block is the last up close candle before a strong downward push. These are the zones where the smart money place their actual blocks of orders. When price eventually retraces to this order block, we expect a strong reaction because the unfilled limit orders of the banks are sitting right there, waiting to be executed. To refine an order block, you draw your zone from the open of that candle to the low or high. Sometimes, if the candle body is too small, you can include the wick of the next candle. To increase your accuracy, you can target the 50% equilibrium level of the order block, also known as the mean threshold. By waiting for the price to reach this deeper level, you secure a much tighter stop loss and a significantly higher reward-to-risk ratio. Part 4. The multi-timeframe ZAO USD setup. Now, let's put all of these simplified concepts together into a step-by-step top-down analysis using a real-world example on the XAU USD chart. Our process always begins on the daily time frame. On the daily chart, we identify the overall market structure and mark the key daily order blocks that are closest to the current price. We do not look at minor wicks, we look for major institutional levels. Look at this XAU USD daily chart. The market is in an overall downtrend, making lower highs and lower lows. We see a strong daily bearish order block at the top, which is left behind an unmitigated fair value gap. This establishes our bearish bias. The overall daily sentiment is bearish. Now that we have our directional bias, we do not look for any buy setups. We only look for sell opportunities. We move down to the 4-hour time frame to refine this zone. Switch to the 4-hour chart. Here, we see the price has rallied upward and is now tapping into our daily bearish order block. Within this 4H view, we refine the daily zone into a smaller 4H supply area. The market direction on the 4H is currently bullish as it retraces, but we know it has tapped into major daily resistance. Next, we drop down to the 1-hour time frame to look for our entry trigger. We are looking for the exact moment the buyers lose control. Part 5. Entry execution and risk management on the 15M chart. Switch to the 1-hour chart. As the price trades inside our refined 4H supply zone, we wait for a structural shift. Look at this. The price was making higher highs and higher lows. Suddenly, it drops aggressively and breaks below the last swing low, creating a 1H change of character, CHoCH. This CHoCH is valid because it did not occur to hunt liquidity or fill a gap. It reacted directly from our daily supply. After the CHoCH occurs, the aggressive drop leaves behind a new 1H bearish order block and a fresh FVG. Now, we have our setup. To execute with absolute precision, we place a sell limit order at the open of this new 1H bearish order block on the 1-5-minute chart. Our stop loss is placed safely above the swing high of the 1H order block, giving the trade enough room to breathe. Our target is placed at the recent daily support, liquidity low. This trade gives us an outstanding 5-to-1 reward-to-risk ratio. By being patient and waiting for the top-down confirmation, we completely avoided overtrading. Price tapped our limit order and dropped beautifully to hit our target. Conquering overtrading with patience. Patience is the ultimate edge of a professional trader. The biggest trap for beginners is the urge to constantly be in a trade, leading to overtrading and unnecessary losses. By implementing this systematic top-down SMC blueprint, you naturally filter out 90% of the market noise and only focus on high-probability setups. Practice this simple plan on your own charts and see the difference. If you found this lesson valuable, please hit the like button, subscribe to our channel, and comment below. Stay disciplined, and we will see you in the next masterclass. If you have any trading topics you'd like to discuss, just press 2 inches, comment, I'll clear things up for you.